What's going on, everybody? It's Jeff here. Welcome back to the channel. What a rocking start we already have to the week for AMC. Guys, in this video, I want to talk about something that is very important because I read a lot of chatter going on all over the internet about what is going on this week. I'm going to get into it. I'm going to explain to you guys everything really to give you a good understanding. But first off, I want to touch base on something that is very important. If there's one thing that I have learned in the last 5 to 6 months while going on through this entire journey through AMC stock is this. The most important thing for you to do yourself is to manage your emotions and manage your expectations. And over the weekend, there was a lot of posts and even some videos being put out all over the internet talking about the insane importance of this week we have ahead of us and what could happen and so forth. And I think it's amazing, and it's also true, guys. This week is a very big week. However, it is not a make or break week. So one thing I really want to talk about right now, and I'm going to explain it to you as simply and briefly as I can, is what the role of a market maker is, okay? One of the biggest misconceptions that people talk about all the time is as soon as you buy a call contract, for example, a market maker goes out into the market and immediately buys the shares to hedge their positions. And that's not the case, guys, okay? The role of a market maker is to be able to stay delta neutral, okay? Which means you have a very similar amount of inflow and outflow, okay? So for example, guys, let's just take a peek at this right here. Right now we're looking at AMC stock, right? It's sitting at about 58 bucks. All of these call contracts that are currently in the money, set to expire in a very, very short time frame, which is this Friday, are currently hedged for. However, when you have stocks that are right now currently sitting over 100% out of the money at like the 145 range, those calls are currently not hedged for. The reason being is this, because first of all, there's two reasons actually. The first one is because if there's an insane amount of call volume happening on a stock, okay, there would never be enough shares available in the float. For example, like AMC, which has a lot of options volume coming into it. There would never be enough shares available in the float for the market maker to buy all of these shares to hedge for a position that has a probability of getting hit of like 5 or 6%. It's just not going to happen. It's also very similar to you guys living in, let's say, I don't know, a $250,000 home and going out and buying insurance, okay, for a home that's value of 600,000 because maybe in so many years it might be worth that. You don't do that, and it's the same thing that these market makers do, okay? You're going to wait to see where the price moves in relation to where it's going. Now, this also works for an inverse effect. For example, if you take a look at AMC, let's go jump back to the let's go jump back to the 5-day, 5-minute chart. And if you look back here on Thursday, there was a steady decline happening in the beginning of the day. There's a couple reasons for that. One, the price was moving very quickly, very volatile. Okay, there was some shorting going on. All right, there might have been some paper hands because there was a lot of FUD being spread around that day. But this is also a time where the market maker will also begin to de-hedge their positions. Meaning, currently, if they were hedging for let's say like the 65, 70, even $73 call that was set to expire on the 11th, because you see it's running up really hard, really high, hit high of 60, okay, on that, what was it, on that Tuesday, they might want to hedge for those positions. However, come Thursday, once this sell-off continued, well, it's the very same thing of what you would do if your home value was decreasing. You're looking at it, okay, well, the time for expiration is really, really, coming really close. It's in less than about 24 hours at that point almost, okay? And we are already in a decline. We're at this point somewhere around, I don't know, the stock would have to rise about 60% to get to that $73 call range. I don't need to hedge for that position any longer, and therefore they de-hedge their position, which means they are selling stock leading to that descent. Okay, so it works in an inverse manner. Now, what's also very important, guys, is they only have so much liquidity to be able to go around, and they're involved with numerous different stocks. So I wanted to really cover, I hope I was able to explain it in a very similar situation. If you look at call options that are already in the money right now, where you have an expiration that's close, they are hedged for. If you look at call options that are in the money and I mean deep in the money, that have an expiration of like leaps, 2022, 2023, those are hedged for. Anything that's at the money right now at a big leap, those are probably not yet hedged for, and that might really depend on the market maker. But when you look at positions that are far out of the money, that have a very close expiration date, they haven't yet hedged for those positions. So where am I going with all of this? Well, one, there's a lot of options volume happening for this Friday, which means some of the positions that might not have been hedged for example, the price closed at, let's say around that, closed around that $50 price range last week. Maybe they didn't hedge for the $65 or $70 calls yet. However, as we get closer to expiration and you see a little bit of a ramp up like we had this morning, hitting that $60 price point again from 50, they're looking to hedge those positions. And it happens very quickly. They will begin to de-hedge depending all to stay delta neutral. This week can be very important because as there's more options getting closer to expiration, it's not just what's going on for this week. That's why when I saw people talking about, this week and almost kind of got the feeling of this was going to be like a make or break, which by no means is it a make or break. The amount of call or the amount of options volume that has happened as is just ramped up. It's been a steady, incline. So right now, the 18th is a big date, but there's a lot of volume for the 25th. There's a lot of volume in July and so forth. And as you're we've increased the price point from around that $10 to $12 range all the way up to almost the $58 as I'm looking at the chart right now. And as you're getting closer to expiration, there's more hedging that needs to be done. Hedging also only happens before expiration. There's no such thing as hedging for a position, okay, post expiration. And what I mean by that is, for example, you're not going to buy car insurance on a vehicle that's already totaled. Okay. You're not going to buy car insurance on a vehicle that you've already sold, which is basically what an expired contract is. It's over. It's null and void at that point. So they don't hedge those positions. It's all done before. Their main goal is to stay delta neutral. They have liquidity caps, so they're not able to just go out and just accumulate all this stock and hold on to it. Okay, just because they hedge for it once doesn't mean they're not going to de-hedge for it. Meaning last week when we were approaching, I think we hit that, I think we closed one day at $62. I think I hit that next morning at 77. If that was pre-market, they might hedge for, positions in the, at the time when they made the strikes all the way out to 145. They might hedge for those $80 and $90 strikes because we were almost at a high 70s at that point. But now once we got down to the $40 range, they're going to de-hedge because they have other plays that they need to be able to spread their liquidity around to. So guys, that's it for this video. Just know that one, this is not only this week, okay? The amount of options volume is carrying this price even further, all right? And it also does work in an inverse and, or a positive and an inverse way. Okay, and like I said, I hope I was able to explain that to you brief enough, guys. I'm excited for this week. I'll keep you posted. I'll see you in the next one.